Uh, no? Okay. So what I'm going to do is I'm going to share my screen. I have already opened up my uh, PDF notes where I will be sharing, with you guys about the MCQs. Okay. Just a sec.
Board.
I hope my screen is visible. I hope my screen is visible. Okay. So I really, to be honest, maybe it would not be much fun if you guys do not respond, do not help me at least bare minimum in the calculation. So please uh, do help me at least in the calculation. Okay. The following scenario relates to questions 1 till 5. Richard employer provides him with the following benefits. What benefits Richard employer has provided? Living accommodation since 1st June 2021. The property was purchased on 1st May 2024 for 162,000 and was valued at 198,000 on 1st June 21. Improvements costing 7,000 were made to the property during November 18. An interest-free loan throughout the tax year 24-25. The balance outstanding at 6th April 24 was 24,200 and at 5th April 25 it was 19,600. Richard taxable benefit in respect of this loan is calculated using the average method. So it's like we will be calculating the benefit of this with the help of average method. Okay. A home entertainment system since 1st November of 24. The entertainment system cost 5160 and is provided for Richard personal use. On what figure will Richard additional living accommodation benefit be calculated for the tax year 24-25? I'm giving you, let's say, a minute or let's say a minute to first hear from you what it should be in your opinion. Please. Yes, please. So what should be? So living accommodation. Living accommodation is based on either cost. Living accommodation is either based on cost or market value. When to pick up cost, when to pick up market value, there was a concept which is called a 6-year rule. If the cost is more than 6 year old when provided to employee, then you have to take up the cost. If cost is less than 6 years old when provided to employee, then you have to take up the market value. Now, if I look 6-year rule, if 6 year less, you have to take up the cost. 6-year rule, if more than 6 year, then you have to take up the market value. Now, if I look over here, property purchased on 10th May 2014 is the purchase date and provided to employee on 1st June 2021. This is the date when it is provided to employee, i.e. Richard. Uh, Very clearly, if I look over here, it is more than 6 years. Then I have to take up the m- market value. So the market value of the property is 198,000. Hence, my expensive accommodation would be calculated at 198,000. Um, is it clear? Is it okay? Please at least do respond me so that I would be aware you guys are clear or not. Okay, so 198. Okay, is it like what should be amount on which additional accommodation benefit will be calculated? So 198 minus 75. 75 is the standard amount. Then expensive accommodation should be calculated on 123. So expensive accommodation would not be on 198, rather it should be calculated on 123. Okay. Uh, any question? No? Okay, I'm moving forward. Next, what is Richard taxable benefit in respect of the interest-free loan for the tax year 24-25? What is the taxable benefit of Richard for tax year 24-25? So the taxable benefit, as mentioned already in the question, if I look into this paragraph, as already mentioned in the question, is on the basis of average method, is on the basis of average method. Now, how to calculate average method? So the average method is like loan at a start, which is 24,200 plus loan at end 19,600 divided by 2. I get the average loan. So the average loan 24,200 plus 19,600, whatever is the average loan. So let me simplify. Multiply by official rate of interest. Official rate of interest is 2.25%, multiply by 12 over 12. So if I look, the benefit under this method amounts normally one interesting confusion with the student. So normally one interesting confusion with the student says, uh, when will this be 12 upon 12, or if there is any situation when this will not be 12 upon 12. So answer to this question is, for average method, it would remain 12 upon 12. It will only be changed. It will only be changed if loan is taken out during the year or loan is completely repaid during the year. Otherwise, if loan exists at the start of the year, if loan repaid during the, if loan exists at the end of the year, then needless to say, this will remain be 12 upon 12. So there will be no change in that. Okay. So I hope this point is very much well clear. Now, if I move to point 3, Where an employee is given an asset which has previously been provided to them, how is taxable benefit calculated? So normally we do this as part of our calculation, but here it is not being asked with respect to the calculation. Rather, here it is being more of asked towards the methodology, let's say in the English language, how to calculate. Okay. Let me start reading from point T, where I'm reading the requirement again. Where an employee is given an asset, where an employee is given an asset. So, for example, if asset is provided to any of the employee given permanently, which has previously been provided to them. It means previously there was asset usage benefit, now asset gift benefit or asset purchase benefit, whatever. How is the taxable benefit calculated? So now the question is, what is the method to calculate taxable benefit? I'm going to start reading from point D. The lower of market value at the date of employees given the asset and the market value plus amount previously assessed as benefit. So is it really lower off? No, it is not lower off. It is higher off. Okay. Second issue. Second issue. The market value plus any amount previously assessed as benefits or market value minus. So it's not plus, it's minus. So there are two issues in this. Let me read to the point C. The greater of market value at the date the employee is given the asset. So the greater of this one is correct. And the market value plus any amounts. So that's the issue. It's not plus any amounts. That is the issue. It's not plus any amounts. It's minus any amounts. B. The lower of market value at the date the employee is given an asset, the market value less any amounts previously assessed as benefit. This is correct. The lower of this is incorrect. So due to this option is incorrect. The greater of market value at the date the employee is given the asset and the market value less any amounts previously assessed as benefit. So the greater of this is correct. This is correct. So in essence, so to conclude, which option is correct? Option A is correct. Okay. Question number 4. What is Richard taxable benefit in respect of the home entertainment system for the tax year 24-25? So for this, the third paragraph is relevant. A home entertainment system since 1st November 24. The entertainment system cost 5160 and it is provided for Richard personal use. So home entertainment system 5160 multiplied by official rate of interest since 1st November 24 till 5th November, sorry, 5th April 25. I'm talking about November, December, Jan, Feb, March. So I'm talking about good 5 months. So multiply by 5 upon 12. So for 5 months, the benefit amount. Can someone please help me in calculation? I really don't want to do the calculation. Anyone? Please. Uh, Kawal, Sean, Omer. Thank you, Mayor. 430. So 430 is the amount of taxable benefit. Okay. I'm moving to the next one, the fifth one. Which of the following benefits can never be exempt? Can never be exempt means it is always taxable. So never means you need to think, even in one situation, can it be exempt? So you need to think over here, never be exempt. Okay. Meals in a staff canteen, can it, are they never exempt? So they are exempt if it is available to all employees. So you need to think, is there any benefit which is not exempt even with the if condition? Okay, or there is no if condition with that other way around if I were to speak. Can I ask again, you guys, please, everyone, uh, what's the answer in your opinion? Anyone? Meals in a staff canteen. The word is never. Meals in a staff canteen can be exempt if available to all employees. So I can tell you based on one condition, at least it can be exempt. So if it is available to all employees, then it will be exempt. So the word is never ever exempt. So it's not never ever exempt. And allowance for working from home, can it be exempt? Yes, it can be exempt if it is less than or less than. Relocation cost, it is exempt if it is less than 8,000. So it is exempt. So there is one condition. If condition satisfies, then it is exempt. I need to figure out the ones which will never ever be exempt. Whatever conditions you adhere, whatever conditions you met, they are never ever exempt. Okay. Health club membership, can it be exempt? Health club membership, can it be ever exempt? No. Health club membership provided to employees are always taxable. It's never ever exempt. Okay. So I'm done with five questions. Before I move further forward, I like to hear from you. Anything, anyone of you want to share? Anyone of you want to ask? Kamal, Sean, Umer, anything, anyone of you want to ask? Thanks, Kamal. Umer, Sean, anything from you? Thanks, Umer. Sean, anything from you? Okay. For the tax year 24-25, SOM has chargeable gains of 23,900. She has unused capital losses of 26,100 brought forward from the tax year 23-24. What amount of unused capital losses will SOM carry forward to the tax year 25-26? What amount of loss SOM will carry forward to tax year 25-26? So for 23-24, there is a capital loss of 26,100, right? For 24-25, for 24-25, there are capital gains by the amount 23,900. And the question is for 25-26, how much loss to be carried forward? So from 24-25, first of all, the annual exemption of 3,000 to be deducted. So it translates into 20,900. Then of this 20,900 can be adjusted max. As a result, how much loss to carry forward? The screen is not showing. Can you see the screen now? Uh, can you can you see the screen now, please? Umair, can you see the screen? So Kamal, it looks to me there is some issue at your end because Umair can see the screen. Sean is on a no response mode, so I cannot comment on his behalf. So Umair can see the screen. Uh, Kamal, I hope this issue sorted. So Umair, the final, what is the amount of loss to be carried forward? 5,200 needs to be carry forward, right? So this is like option C. By the way, this is something which was asked in your WhatsApp group as well, where one student asked the similar type of question. And to be precise, the question was, even if it's mentioned as soon as possible, do we still need to deduct the annual exemption first? The answer is yes, whatever is mentioned, we need to deduct the annual exemption first. Okay. Moving to the next question. For the tax year 24-25, Alistair taxable income is 34040. During the year, she sold an antique vase and this resulted in chargeable gain of 33,900. What is Alistair CGT liability for the tax year 24-25? So chargeable gain of 33,900. Taxable income is 34040. Um, Taxable income 37,700 is the basic rate band, of which covered by taxable income 34040. As a result, space available in basic rate band available is 37,700 minus 34040. Please quickly. It's 3660, right? Now, double 3900 of this 3660 would be at the rate 10%, and the amount which exceeds from basic rate is 27,240 at the rate 20% is. As a result, total CGT liability amounts these total amounts 5814. Kamal Aftab, can you see the screen now? Um, Kamal, I suggest you to log off and try to log in again, because honestly, this is something which is only with you. So I really wondered that it's not issue at my end. Otherwise, Umair would be facing the same issue. Okay, let me give one more try for you. I reshared the screen, Kamal. Any good news? You can see it now? Yes, sir. I assume this. Oh, perfect. So that's fine. So if it's showing to you now, that's perfectly fine. Okay. So I'm on question 8 now. Dash Limited sold a factory on 7th Feb 2025 for 260,000. The factory was purchased on 4th July 1999 for 114. The indexation factor from July 99 to December 2017 is 0.766. So the question is, What is dash limited chargeable gain in respect of the disposal of factory? So I'm like disposal proceed. Disposal proceed is by the amount 260,000. Cost indexation allowance. Can someone please help me in this? Please. Sorry, it should not be 260. It should be, sorry, my bad. It should be 114,000 because indexation allowance is on cost, not on proceeds amount. It's 87324. Index cost amount 201324. Gain amount gain amount 58676. Yes, Umer. Jade sold 25,000 £1 ordinary shares in Silver PLC on 13th March 25. Jade had purchased 60,000 shares in Silver PLC on 18th Feb 15 for 72,000. On 28th May 18, Silver PLC made a 144 bonus issue. What cost figure will be used in calculating the chargeable gain on the disposal of Jade's 25,000 ordinary shares in Silver PLC? So are you clear with the question? So what should be? So it is basically the concept of matching principle, and please be very clear. The requirement, the examiner is not asking you to calculate the gain amount. Very clearly read the requirement carefully. What cost figure should be used? What cost figure should be used? Okay. So as per matching principle, is there any same day purchases? He is disposing of shares on 13th March 25. Is there any same day purchases? The answer is no. Is there any next 30-day purchases? The answer is no. So whatever is the disposal of 25,000 shares, that should be come from the pool, right? So from the pool, uh, on 18th Feb 15, purchased 60,000 shares for amount of 72,000. Then 28th May 2014, 144 bonus issue. So for bonus issue, the cost is nil. As a result, the total number of shares amount 72,000 divided by 75,000. From this, I will get cost per share. And if I multiply cost per share by 25,000 shares, which I basically sold, I'll get the answer. So thank you, Kamal. 24,000, is it fine? Calculations clear? During March 25, an investor made four disposals of shares in unquoted trading companies. So all these shares are unquoted trading companies. All these shares are unquoted trading companies. All these shares are unquoted trading companies. Which disposal would qualify for investor relief? So the sweet and simple question is, which of the following disposal qualifies for the investor relief? Which of the following disposal qualifies for the investor relief? Which disposal qualifies? Shares purchased from a shareholder during July 2020. Purchased from a shareholder means these shares are not subscribed. Hence, no investor relief. Shares acquired by subscription during June 21. June 21. So via subscription, right? June 21 is like more than 3 years. Yes. Shares purchased from a shareholder during March 24. Any one condition is fine, but two conditions. Shares acquired by subscription during August 22. During August 22. Shares acquired by subscription during August 22. So subscription is fine, but August 22 means, so I hope this should be pretty much clear. The following scenario relates to questions 11 to 15. So this is basically a section B type question where one scenario belongs to five scenarios or five questions. Okay. J disposed of various assets during the tax year 24-25. And these disposals resulted in chargeable gains of 46,400 qualifying for business asset disposal relief and another 123,000 of chargeable gains not qualify for business asset disposal relief. So it means there are two types of gains. One type of gains qualify for business asset disposal relief and another type of gain do not qualify for business asset disposal relief. The gains which qualify for business asset disposal relief is like 46,400 and another one which do not qualify for business asset disposal relief is 123,000. None of the gains are residential property gains. None of the gains are residential property gains. So I hope you are clear. Like there is no need, no point to think about residential property element. On 19th April 24, Jay sold 5 hectares of land for 72,000. He had originally purchased 8 hectares of land on 7 June 15 for 68. The market value of the unsold 3 hectares of land as at 19th April 24 is 40,500. On 8 June 24, Jay sold antique table for 12,800. The table had been purchased on 2nd May 13 for 1300. On 19th October 24, Jay made a gift of his entire shareholding of Pound 1 ordinary shares in AMZ PLC to his son. On the date of gift, the shares were quoted at 10.2 to 10.64. On 10th May 25, Jay sold a factory and this disposal resulted in a chargeable gain. Jay does not have any taxable income for 24-25. Jay does not have any taxable income for 24-25. What does it mean? It means that there is no taxable income for 24-25. First of all, what cost figure will have been used in calculating the chargeable gain on the disposal of J 5 hectares of land? So basically talking about point 1. Market value of parts sold divided by market value of whole asset multiplied by original cost. So the market value of parts sold D option. So 3520. Um, right? Should I move forward? What is J chargeable gain in respect of disposal of antique table? Antique table. Antique table. It is tangible movable. Yes. Useful life more than 50, less than 50. Useful life since the word is antique. So that's why I can tell the useful life is more than 50, right? So for more than 50, two methods disposal proceed cost, gain, and second one 5/3 disposal proceed minus 6,000. So 5/3 rule. The answer is sorry 11,133. Thank you. So I need to pick up lower of these two. So the lower of these two is 11,133. So that will be the gain amount for me. Moving to the 13th. What market value figure will have been used in calculating the chargeable gain on gift of EMZ Limited share? What's the market value? So market value of shares, it's basically half, sorry, let me keep it simple. Average of ask and bid price. It's 10.2 plus 10.64 divided by 2. That works out to be 10.42 average of ask and bid price. Moving to the next one. During what period must reinvestment take place if J wishes to claim rollover relief in respect of chargeable gain arising on the disposal of the factory? So reinvestment. 10th May 25, J sold a factory resulted in chargeable gain. J sold a factory on 10th March 25. The reinvestment period is last 12 months, next 36 months. So last 12 months means 10th March 24, and next 36 months means next 36 months means March 25, 26, 27, 28. So I'm good talking about 10th March 28. So 10th March 24 to 10th March 28, option C. Last. What is the JCGT liability for the tax year 24-25? So what is the CGT liability for tax year 24-25? So CGT liability for 24-25, 46, and please keep remember, J does not have any taxable income. So even does not have taxable income. Like we discussed, Tax bands are first covered by the BADR, right? So 46 400 into 10%, 123 300 into, so all of the BADR, sorry, all of the basic rate has been covered by the BADR. So the non-BADR gains amount, so sorry, the rest of the gains directly fall into the high rate. So 24660, 28, sorry, someone is saying something. Sorry, Aisha, maybe you missed. So 46 400 and another 123. Now fine. X Limited owns 90% of ordinary share capital of BAT Limited. BAT Limited in turn owns 70% of ordinary share capital of Club Limited. Club Limited owns 100% of ordinary share capital of D Limited and 90% of ordinary share capital of E Limited. Along with BAT Limited, which companies form a chargeable gain group with X Limited, along with B Limited? So B Limited is there. Along with B, which company creates chargeable gain group? Oh, sorry. Thank you, Kaval. 80%. Thank you. Yes, anyone, any feedback? Aisha, Kaval, Sean, Umair. Group structure is very clearly in front of you. Which companies form chargeable gain group? Chargeable gain group, direct shareholding, 75 above. I mentioned the rule as well. Now, again, a question to you. Kaval, I hear you. Option B, you said C and D. You are not including E. E isn't indirect shareholding. Kamal, on your feedback, and Kamal and Aisha, I request to both of you, please share your message with everyone. Uh, Kamal, on your point, E has indirect shareholding of more than 50, right? So why not you including E as well? Aisha, I hear what you are saying, but if I ask you, in your opinion, what would be the answer? Omer, you as well? Aisha, the answer is correct. So if you ask me what is the correct answer, none other companies. So you rightly pointed out, Aisha. Option D is the right one. So to Kaval, to Umair, to Sean, the correct answer is option D. Why? Because for capital gains group, the first condition is direct shareholding should be more than 75. Indirect shareholding is secondary. So for C, since the direct shareholding condition is not met, for C, since direct shareholding condition is not met, hence I cannot even think that it will be part of capital gains group. Okay. So it will not be part of capital gains group because the indirect shareholding is only checked if direct is more than 50. Sorry, more than 75. Is direct is not more than 75, then there is no point to check for the indirect ones. I hope the explanation is clear. Guys, I hope the explanation is clear. Thank you. Green Limited owns 100% of the ordinary share capital of Blue Limited. For the year ended 31st March 25, Green Limited has taxable total profits of 132. For the 9-month period ended 31st December 24, Blue Limited had a trading loss of 84,000. How much of Blue Limited trading loss can claim against profits for the year ended 31st March 25? Um, so if I look over here, Green Limited is claimant company and Blue Limited is surrender company, right? Green Limited. Green Limited. Year is from 1st April 24 till 31st March 25. And for Blue Limited, it's 9-month period ended 31st December 24. So 9-month period ended 31st December 24 means, so it means if I think the corresponding period is of 9 months and 9 months of corresponding period means I need to look the loss is by the amount 84, which is already for 9 months, and the profit is 132,000, which is of 12 months. So 132,000 is of 12 months. So if I were to calculate for 9 months, so for 9 months, that turns out to be, for 9 months, this turned out to be 99,000. So 99,000 is the amount of loss which can be observed. But what is the maximum amount of loss? So what is the available loss? So the available loss is basically 84. Hence, the correct answer is option B, i.e. Uh, Green Limited cannot Green Limited cannot claim more than 84,000. Great. I hope that's clear now further. Which of the following cannot be surrendered as part of current year group relief claim? Cannot be surrendered as group relief claim. Cannot be surrendered as group relief claim. Can I have your feedback? Anyone? Your option? Like, what option you would have marked for this question? So I have only two feedbacks. D may be the capital loss. That's correct, Aisha and Kamal. Option D is the right one because capital losses can never ever be adjusted under the group relief claim. Capital losses can only be adjusted under capital gains group concept. Okay. So they are not adjusted under capital losses regime. Sorry, under group relief regime. Is it clear? Interesting. Soup Limited owns 100% of the ordinary share capital of several loss-making companies. The results of Soup Limited for the year ended 31st March 2025 are trading loss, property income, loan interest receivable, capital loss, qualifying charitable donations. The loan interest receivable in respect of a loan which was made for non-trading purpose. Requirement. What is the maximum amount of group relief which can be claimed by Soup Limited for the year ended 31st March 25? What is the maximum amount of group relief which can be claimed by Soup Limited for the year ended 31st March 25? We are talking about group relief. We are not talking about capital gains group, right? We are talking about group relief. So be clear on that. Trading loss to be included, property income to be included, loan interest to be included, capital loss excluded because as we discussed in the previous question, capital losses cannot be adjusted because they have their own mechanism which is called as capital gains group. Qualifying charitable donation 2000. So if I were to make a sum minus 8400 plus 55,200 plus 2,900 minus 2,000. So whatever is the amount is the maximum amount of group relief which can be claimed by SOUP Limited. So what is the maximum amount of loss which can be claimed by SOUP Limited? That is 47,700. Umer, 6 quarter to 6 somewhat. I hope you're not tired. Yes, Aisha, please. So, Aisha, on your question, just to clarify, are you talking about individuals? Are you talking about companies? So, if you're talking about companies, yes, trading income is adjusted from total income. Total income. That is correct. Oh, so is it something? Uh-huh. So maybe you're missing something. So here I'm supposed to calculate total income. Maximum amount of group relief which can be claimed by SOUP Limited. So maximum amount which SOUP Limited can claim, right? So maximum amount is always, so here SOUP Limited is claimant company. Be clear with couple of facts. SOUP Limited is claimant company. There would be other loss-making companies. So SOUP Limited wants to claim the loss. So how much loss they can claim? Perfect. CAT Limited owns 100% of the ordinary share capital of Mouse Limited. Both companies prepare accounts to 31st December. Both companies prepare accounts to 31st December. Both companies prepare accounts to 31st December. Any implication? Any implication? It means the implication I was asking is only one which I can thought, which is there is no concept of corresponding period. On 10 June 24, Mouse Limited sold an office building and this resulted in a chargeable gain. On 20th November, CAT Limited sold a factory and this limited in a capital loss. By what date must CAT and Mouse Limited make an election if they want their respective capital loss and chargeable gains to be matched? Okay, so it's more of, a theoretical question. So first of all, they are part of capital gains group. First of all, they are part of capital gains group. Under capital gains group, capital loss, capital gain can be transferred to each other. But here the question is not on a conceptual grounds. Here the question is on a uh, election perspective. Like M Limited has a gain, Mouse Limited has a gain, Cat Limited has a mouse. By what time you have to make the election? So if I tell you principally, if I were to make a principal statement, election time is 2 years from the end of accounting period in which assets are sold. So if I think the year end date is the year end date is 31st December 24. So from 31st December 24, you have 2 years time to claim, which is is this thing clear, everyone? Thanks, Aisha. Wong died on 4th January 25. When his wife, Wing, died on 3rd August 20, her entire estate of 200,000 was left to Wong. However, Wing had made a gift of 100,000 to her daughter on 2nd May 20. This figure is after deducting available exemptions. The nil bid for the tax year 2021 is 325. Ignoring our NRB, how much NRB is available against Wong estate? Okay, so all of our estate was left to Wong. So this part of the estate is exempt because it is transfer between spouses. Since this is transfer between spouses exempt. So NRB for Wong would be Wong own plus Wong wife unused will be transferred. Wong own NRB is 325 plus Wong wife unused NRB would be Wong wife unused NRB would be 325 was her NRB, of which 100,000 was used by PET, right? So as a result, that somewhat translates into So thanks, Aisha, for raising. Others, I hope this should be pretty much clear. Thanks, Kamal. On 22nd May 2023, Winston made a gift of 4,400 to his son, and on 7 September 24 made a gift of 7,200 to his daughter. What is the value of PET made on 7 September 24 by Winston to his daughter? So basically, they are asking is net PET value as a question. And if I were to calculate what's the net PET value, so the net PET value would be PET annual exemption of 24-25, annual exemption last year. Is it unused? Annual exemption last year. Is it unused or is it already used? Why I mentioned not available? So I am like it is as already used by I hope that's pretty much clear. Everyone, quick, quick, please. Perfect. Thank you for the feedback. On 12th June 24, Arnold made a gift of 440 to the trust. This figure is after deducting available exemptions, means annual exemption, marriage exemption, etc., is already done, right? Arnold will pay the IHT arising from the gift. He has not made any previous lifetime gifts. He has not made any previous lifetime gift. Lifetime IHT liability. So 440 is the CLT less NRB because this is already after annual exemption. This is already after annual exemption. Thanks, Aisha. Let me just cross check the numbers. So that somewhat talks about 1 15,000, the amount which exceeds from NRB. IHT would be at the rate 25%. Why I'm taking 25%? Because because Arnold is going to pay the tax. So 28750. Yeah, person is paying tax. That's why it's 25%. That's point one. Point two, if A dies in 7 years, this CLT would become taxable. The amount of what will be the taxable amount of CLT? So the taxable amount of CLT would be 440,000, i.e., the amount of CLT plus the amount of tax paid by the person, which is 28,750. So it's like uh 2687, sorry, 468,750 would be the amount of tax then. Is it clear? Thanks, Aisha. Others, is it clear? Do you want any discussion or clarification? Thanks, Kamal, for the feedback. I'm moving forward. On 20th November 14, sorry, 20th November 24, Alex made a gift to a trust, and this resulted in a lifetime IHT of 46,000. What is the due date of IHT liability of this 46,000? What is the due date of IHT liability? So for IHT liability, I need to see. So the IHT liability, if CLT is made from 6th April, from start of fiscal year to 30th September, then due date is 30th April after fiscal year. And if CLT is made from 1st October of the year to 5th April next year, then IHT due date is 6 months from month end of transfer. So this is the default philosophy, I would say, to calculate the lifetime tax. Now, just need to mirror this overall story over here. The CLT date is 20th November 2024. Means CLT date is in this category. So month end would be 30th November 24. And from this month end, I'm talking about 6 months. So 6 months is like 31st May 2000 and um, is this thing clear? CLT date, this thing clear? Thanks. Thanks. Next, Violet has an estate valued at 700,000, but she does not currently own a main residence. She does not currently own a main. I hope you can hear me now. Perfect. Interesting question. So the question is, how much IHT would be saved if she purchased main residence for 340,000? So her estate is 700, is her current estate, but she does not currently own a main residence. Under the terms of her will, Violet estate is left equally to her children. All of her estate would be left to children. Violet husband died on 26 May 20, and all of his estate was left to Violet. It means that his NRB is completely available. His NNR, RNRB and NNRB both are completely available, right? Just imagine, since Violet estate does not include any of the RNR, sorry, any of the residential property, hence RNRB would not be available to Violet, right? RNRB would not be available to Violet. But if residential property is added, then RNRB would also be available, right? So just to start with, if no residential property in state, then in that situation, Violet own RNRB of 175,000 would not be available. Violet husband RNRB of 175 would not be available, right? As a result, can I say on combined basis 350,000 of RNRB would be wasted, right? Now, as an idea, as a tax planning aspect, I am saying, Violet, if you add residential property in your estate, if you add residential property in your estate, you will get your own RNRB of 175. You will got your husband RNRB of 175. As a result, total RNRB you are eligible would be of 350. We are talking about residential property, right? So since RNRB would then be restricted to 340, so it means can I say 340,000 multiply by 40%, 340,000 into 120%, which somewhat translates into 136,000 of IHT would be saved. So can I say that somewhat 150,000 of IHT would be saved? Is this thing clear? 136,000. Does it make sense to you guys? Thanks, Aisha. Um, Others, please. Dua, Faiza, Kamal, Sean. Thanks, Kamal. Thanks, Faiza, for the feedback. Dua, are you clear? Perfect. So this is a very great question of, the text planning type of stuff. Be mentally prepared to look for these type of questions in the exam. The following scenario relates to question 26 to 28. You should assume that today's date is 20th March 25. Min and Mon, a married couple, respectively aged 76 and 70. Min has a chargeable estate of, for IHT purpose, valued at 850. He owns two properties, respectively, valued at 336 and 413. The first property has an outstanding repayment mortgage of 160, and second property has an outstanding interest only mortgage of 84. Ming owes 18,400 in respect of a personal loan from a bank, and he also verbally promised to pay legal fees of 4,200 incurred by his nephew. You guys know about it, right? You guys know about it. Min expect the cost of his funeral to be 5,400, and this cost will be covered by 6,000, which he has invested in individual savings account. Under the terms of his will, Ming left all of his estate to his children. The residence nil rate band is not available. On 22nd August 15, Min had made a gift of 110 to his daughter, and on 12th October 24, he made a gift of 200,000 to his son. Both these figures are after deducting available exemptions. The nil rate band for the tax year 15-16 is 325,000. What is the net value of two properties and related mortgage which have been included in the calculation of min chargeable estate of 150? 850. Property 1, 336. Property 2, the sum of this amount. It is 329 and it is 176. So the sum amount 50. Done. I'm not spending too much time in continuously asking. I'm moving forward. I'm a bit cautious of time as well. So we have a total of 45 questions to cover and I'm at 27. What is the total amount of deductions which will have been permitted in calculating mean chargeable estate of 850? So it is 18,400, 4,200, you guys know not allowed, 5,400. So the total of deductions amount 23,800. I hope you guys understand why I deducted 4,200. What amount of IHT will be payable in respect of mean chargeable estate valued at 850,000 were he to die on 25th March 2025? It's not 24, it's 25. Typo error. The question is how much IST would be payable, right? So, first of all, if I think his death day is 25th March 2025. On 22nd August 2015, Ming made a PET of 100 and Ming made a PET of 110,000. August 15. Today is March 25. Is it taxable today? No, it is exempt. Why it is exempt? Because it is like more than 7 years. Then 12th October 24. PET of 200,000. Taxable falls into NRB. Then death day. 325 is the NRB. Of this 325 of NRB, 200,000 is already consumed. 200,000 is already consumed by the PET. Thanks, Aisha. Thanks, Kamal. Uh, Dua, Faiza, are you guys okay with this? Thanks. Next, 29. On 25th March 25, Moon is planning to make a gift of 1,000 shares in ACE Limited, an unquoted investment company, to her son. Moon currently owns 5,500 shares of ACE Limited, issued share capital of £10,000 one ordinary shares, 16 each, 10 each, 45%, 36 each for a holding of. So basically, requirement is what will be value will be transferred by Moon in respect of a gift of £1,000 one ordinary shares in ACE Limited to her son. So basically, I'm supposed to find diminution in estate or reduction in wealth over here. Before gift, Moon has 5,500 shares, which represents 55%, and for 55%, each share was valued at 36 each. After gift, she would have left with 4,500 as she gifted 1,000 shares. 4,500 means 40%, 45%, and for 45%, it's 21 per share. So 5,500 into 36, 198,000. As a result, diminution in estate amount. Thanks, Aisha. Thanks, Kaval. Thanks for the feedback, Faiza. Thanks, Dua. Uh, I'm moving forward. Why might it be beneficial for IHT purpose for Moon to escape generation so that lifetime gifts are made to children rather than to her children? I hope you recall the concept of escaping the generation. What is escaping the generation? So, escaping the generation is, for example, a person named as grandfather, estate transferred to father, and from father transferred to son. That is the normal practice of IHT. Escaping the generation says, skipping the generation says from grandfather to father to son, directly transferred to son. That is the skipping the generation. Okay. Why might it be beneficial for IHT purpose? So what's the benefit from IHT purposes? To maximize the use of NRB? No. NRB for grandfather remains the same. Because there is greater chance of gift becoming exempt. We are not talking about gift. And for lifetime gifts, it's not the transferee to die, it's the transferer to die. So grandfather, whether he transfers the gift to father or to grandfather, if grandfather dies, the lifetime gifts become taxable. So it makes no difference. To avoid double charge to IHT, the answer is yes, because if grandfather transferred to father, one IHT, father transferred to son, second time IHT. So the skipping the generation concept says, if you directly transfer the asset to son, you will save the father's IHT. It postpones the IHT liability. The answer is no. IHT liability due date timings remains the same. There is no change in the IHT liability due date and or timings. Let me repeat it, Dua. So option B says there is a greater chance of gift becoming exempt. Just imagine, grandfather transfers to father, grandfather transfers to son, grandson. Does it make any difference from lifetime transfer taxability perspective to whom it is transferred? So let me rephrase. For PET or CLT becomes taxable, whose death you mainly look for, the transferor or transferee? For PET or CLT to become taxable, whose death you primarily look for? Is it the transferor death you look for, or is it the transferee death you look for? Donor death, right? Transferor death, donor death. In this example, donor is grandfather. So whether he transfers to F or whether he transfers to son, if grandfather dies, whoever is the donee, like you said, or transferee, like I'm saying, it would become taxable. It makes no difference. So it's not a benefit at all from skipping the generation perspective. Um, Perfect. Nothing to thanks. Joe is self-employed. During the year ended 5th April 25, he purchased a new motor car with CO2 emission of 62 gram per kilometer. The motor car is used by an employee and 30% of the mileage is for private journeys. 30% of the mileage is for private journeys. The motor car is used by an employee. Okay. How will the motor car be treated when calculating capital allowance? It will be kept separate. Okay. So one more thing. 62 gram per kilometer, right? So from capital allowance perspective, I'm for sure it would be 6%. It's not 18%. If it is used by an employee, would it be considered as privately used asset? If it is used by employee, would it be considered as privately used asset? The answer is it is not PUA because the concept of PUA arises when owner use the asset partly for business purpose and partly for private purpose. It's not the owner using it for business private purpose, rather it is the employee who is using for business private purpose. So for employee, it is not considered as PUA. Please keep remember. It will be kept separate? No. 18%? No. It will be kept separate, writing allowance 6%. This is correct, but it will be kept separate? No. It will be included in main pool, special rate pool. Main pool, no, because CO2 is more than 50 gram per kilometer. So the correct answer is option B. During the year ended 31st March 25, Circle Limited incurred leasing cost of 2,700 in respect of a motor car with CO2 emission of 84 gram per kilometer. How much of leasing cost will be deductible in calculating trading profit for the year ended? So for lease cost, let me remind you the principle. For lease cost, we need to check the CO2 emission. If CO2 emission is more than 50 gram per kilometer, then 15% is right. So that's the standard principle. Now let's translate the principle. 84 gram per kilometer. The question is how much of the leasing cost is deductible, right? So thanks, Aisha, for the support and calculations. 2295. Is it clear? Simone uses her own motor car for business travel. During the tax year, she drove total 13,600 miles in the performance of duties without reimbursement from her employer. What expense claim Simone can make in respect of her business travel? 900. That's pretty much clear, right? I'm moving forward. Janin was provided with a new petrol-powered company car on 6 Feb 25. 6 Feb 25, 6 Feb 25, 6 Feb 25, the car was provided. 6 Feb 25, the car was provided. It means the car is used 2 months in. The motor car has a list price of 8,900 and official CO2 emission rate of 117 gram per kilometer. What is Jen's taxable benefit in respect of company car for the tax year 24-25? It's 117 gram per kilometer and the car is petrol car, right? Sorry. It's 12.4, make it 12 at 55 gram per kilometer. It's 16. So the sum amount for 2 months amount. Thanks once again, Aisha. Done. I'm moving forward. Guys, if someone feels like, sir, uh, please wait for us. So please do raise your hand. Sir, please do wait if you want to say anything. Otherwise, if I do not hear anything, I by default assume you guys are perfectly fine and you guys do not have any questions. So, like someone stopped me or requested some clarification few minutes ago, that's perfectly fine. Perfectly fine. But if you have any question, please do raise your hand for the help support. Okay. Um, Bernard is self-employed and has a motor car which is used 60% for business mileage. During the quarter ended 31st March 25, he spent 720 on fuel for both business and private mileage. The relevant quarterly scale charge is 306. Both figures are inclusive of VAT. I'm putting my phone for charge for let's say 1-2 minutes. I hope it will be charged by that time. Motor car, fuel. Fuel related, the principle was for fuel, all of the input VAT can be recovered, but output VAT must then be accounted for. For output VAT, there were two approaches. For output VAT, there were two approaches. Approach one, input VAT can be recovered in full based on the actual cost of fuel. But output VAT must then be accounted. To calculate output VAT, there were two approaches. One approach was called as, and second approach was called as charge to employee. Here, are we talking about employee or are we talking about sole trader? We are talking about sole trader. So here, the output would be on the basis of scale charge. How much input VAT can Bernard claim in respect of fuel for the year quarter ended 31st March 25? So it's 720 he spent on fuel divided by 120. Scale charge 306. Can you please, Aisha, can you please tell me this? 306 divided by 120 multiply by 20. It's 51. Is it really 51? Okay. If I read the requirement again, how much input VAT can Bernard claim in respect of fuel? How much input VAT? So this is input, this is output. So one possible approach would be someone would say it would be 120 minus 51, or someone would say it would be simply 120. You need to think, you need to think, you need to think, uh, what should be the answer? Should it be output minus input net, or are we supposed to respond the gross input VAT amount? What should we respond? So 51 is the output VAT, it's not the input VAT. So scale charge and charge to employees the way to consider to calculate the output VATs. Okay. So input VAT is 120. So either it is 120 input or 120 minus 51, somewhat 69, if I'm not wrong. So what looks to me correct is, okay, so Kamal, to answer your point, if it is to be 69 na, then in the requirement, the wording is used as net input VAT. Unless the word net input VAT is mentioned, then you are generally supposed to respond the gross output or the gross input amount. So gross output, like the net means output minus input, right? So total input or total output. So here, what I'm interpreting from this requirement is, or the generally is, it is total input you are supposed to respond, not the net input, total input. Okay. Is this thing clear? The VAT related? Perfect. Next. Jerome is a decorator on 20th July 24. He started a contract to decorate an office building, completing the contract on 23rd August 24. An invoice was issued for the full amount of contract on 30th September 24, and this was paid on client on 10th November 24. The concept of text point. In the context of text point, the basic text point for goods is when delivered, services when completed. Then the second discussion was invoice issued. If invoice issued in 14 days of basic tax point, then invoice date becomes your tax point, right? Two things. Third, if invoice issued or payment received before tax point, then this date becomes your tax point. This is the overall principle I mentioned. I did not relate it to the scenario. I did not think about scenario. Now I'm starting putting the dates over here. Here we are talking about services. So goods I put across services. When the services were completed. When the services were completed. 23rd August 24. So the basic tax point is 23rd August. Invoice issued 3rd September 24. Is invoice issued within 14 days? Yes, no. Is invoice issued within 14 days? The answer is, so invoice date becomes the tax point. Last, if invoice issued payment received before tax point, then this date is by default tax point. Cash received on 10th November, would it, since cash is received after the tax, after the invoice issue, would it be, can it be tax point? Can it be tax point? The answer is no. So what is the tax point over here? The invoice date becomes the tax point. Is it clear? Why 3rd September? Uh, Aisha? No, not clear? Still not clear? I can explain. I'm happy to explain. So I understand Aisha has issues. What about others? Yeah, sure. So Aisha, first of all, basic tax point. Basic tax point is the date when goods are delivered, or for services, the basic tax point when services are completed, right? I hope that's clear. Second point, if invoice is issued within 14 days of basic tax point, then invoice date becomes the tax point. That's the second principle. If invoice is issued within 14 days of basic tax point, then invoice date is the tax point. Or if invoice is issued after 14 days, then the basic tax point remains the tax point. Third, if invoice is issued or cash is received before basic tax point, before basic tax point. So the basic tax point is for uh, basic tax point before, then that date becomes the tax point. So then I started plotting these dates. What is the date when services are completed? So services are completed on 23rd August 24. Okay, so that is the basic tax point. Then I checked, is invoice issued within 14 days of basic tax point? Second thing to check. The answer is, I found yes, invoice is issued within 14 days of basic tax point. So invoice date becomes the tax point, basic tax point ignore. For third point, Is invoice issued or cash received before basic tax point, or is it after basic tax point? So if I look over here, invoice is issued on, is it before basic tax point or after basic tax point? Very clearly after basic tax point. That's why payment date cannot be the tax point over here. Thanks, Aisha. Others, please. Um, Dua, Faiza, Kanwal, Sean. Thanks, everyone. I'm moving forward. I'll come on this question shortly, but I like to discuss this first. In which circumstance will a VAT registered business be required to issue a VAT invoice? In which circumstance will a VAT registered business be required to issue a VAT invoice? Required means mandatory, not optional. When standard rated supplies made to any customer, when any type of supply is made to any customer, when standard rated supply is made to a VAT registered customer, when any type of supply is made to a VAT registered customer. So I do recall this question is exactly similar question was there in your VAT notes as well. You just need to recall from your VAT notes. So can you recall from the VAT notes? So Aisha, I hear you. I just want to hear from others before I give my own feedback. Anyone else, please? So since majority are with option C, so I'm putting option C. Because if you look here, the word any customer is wrong. Here, any type of supply and any customer is wrong. Here, any type of supply is wrong. This part is correct. Okay. Ming prepare VAT returns for the quarter ended 31st March, 30th June, 30th September, and 31st December. So Ming prepare VAT returns on calendar quarter basis. On 10th May 24, she purchased standard rated goods costing 5,000 from an overseas supplier. The goods were sold for 8,000 on 2nd August. These figures are exclusive of VAT. What entries will be made on Ming's VAT return in respect of these goods? Output VAT of 1,600 for the quarter ended 30th September 24. This is correct. This is not wrong. This is, I would say, incomplete, but this is correct. Input and output VAT of 1,000 for the quarter ended 30th June and output VAT of 1,600. Input VAT of 1,000 for the quarter ended, output VAT 1,600. This is also correct, but incomplete because it does not consider this aspect of VAT. Input VAT, sorry. Input VAT of 1,000, output VAT of 1,600 for the quarter ended. So this statement is factually wrong. So wrong factual is only option D. A and C are not wrong, but they are incomplete. Option B is only complete. Okay. I hope all of you guys understands option B because the concept behind option B is called as reverse charge procedure, which is a part of Which item of information is not required on a simplified VAT invoice? Which item of information is not required as part of a simplified VAT invoice? The supplier VAT registration number, supplier name and address, customer name and address, rate of VAT. Rate of VAT is mandatory. This is what I can confirm. From option A, B, C, what's your view? Yeah, that's correct, Dua. So the customer name and sorry. So the customer name and address is not required under simplified VAT invoice. But if it's a detailed or a normal VAT in, by the way, what's the definition of simplified VAT invoice? Definition. Yeah, thank you, Dua. VAT inclusive total is less than 250. How will an overpayment of VAT of 5400 be reclaimed from HMRC? So it's like you have made an overpayment, uh, and you are like you need to claim it from HMRC. You want to claim it from HMRC. So the concept of error, if error is small, adjust in VAT return. If error is large, inform in writing to adjust. A small error is any error which is below the higher of 10,000 or 1% of, yeah. So can I say by default, any error below 10,000 would always be small error? Any error below 10,000 would always be small error, right? So this 5400, technically speaking, is, I hope we understand this 5400 is a small error. I hope we all understand that this 5400 is a small error. If a small error, then what to do with this? If it's a small error, then entering it on the current VAT return straight away by making separate claim, resubmitting the incorrect just for the overpayment. So these type of things are required. These type of things are required if you need to adjust in the next VAT return. Sorry, if you need to inform to HMRC. Just a second. Just a second. Sorry, getting instructions on the way back to home. So I hope that's pretty much clear, right? Um, Dua and Faiza. Okay, perfect. Um, the following scenario relates to questions 1 till 41 to 45. Alice commenced trading on 1st January 24. During the period 1st January to 30th April, her taxable supplies were 9,000 per month. During the period 1st May to 31st August, they were 10,500 per month, and during the period 1st September to 31st December, they were 12,000 per month. Alice is now in the process of completing her VAT return for the quarter ended 31st March 25. During the quarter, sales invoices totaling 66,900 were issued in respect of a standard rated sales, while standard rated expenses amounted to 19,200 inclusive of VAT. From what date Alice required to be registered for VAT? So Alice required to register for VAT. So first of all, I need to check 12 months turnover. So from 1st January 24 to 30th April 24, 9,000 per month. 4 months we are talking about, sum up to 36,000. 1st May 24 to 31st August 24, 10,500 per month. That works out to be, we are good talking about 78, right? Sorry. September 24th, for 12 months turnover threshold was 90,000. So 30th September. Within 30 days, Alice has to apply for registration, right? And 1st of next month, start charging the VAT. So the correct option is option A, 1st November. Right? Yeah, Dua. So you have to notify within 30 days to HMRC, like, congratulations, I'm in the big boys league. I'm in the league of ones who have turned over more than 90,000. 30 months, no, 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 not 30 months, 30 days from end of month. So I understand you are trying to write days, it's a typo on your end. No worries. Which one of the following is not a condition for the recovery of pre-registration input VAT in respect of goods? Pre-registration input VAT in respect of goods. Two conditions. Should be purchased within last 4 years and should exist at time of registration. Within last 4 years and exist at time of registration. Okay. Which of the following is not a condition? The goods must have been acquired within 4 years of registration. This is a condition. Let me do it other way around. This is a condition. The goods must have been acquired for business purpose. It's like, duh, obviously, it has to be acquired with for business purpose, because if you're not acquired for business purpose, you cannot recover input VAT on that. The goods must not have been sold or consumed prior to registration. Yeah, and that shows that it exists at time of registration date, right? Because if you have sold, it does not exist at time of registration date. You cannot recover input VAT on that. The goods must have been paid prior to the registration. Is payment necessary prior to the registration? The answer is no. The answer is no. Like, payment is not a criteria at all, because VAT is not on cash basis unless following cash accounting scheme, VAT is on accrual basis. Like we discussed few minutes ago about the concept of tax point, where you delivered the goods, you issued the invoice, tax point established. That's it, full stop, tax point established. Okay. How much VAT Alice will have to pay HMRC for the quarter ended 31st March 25? It means we are talking about output VAT, input VAT, or net VAT. We are talking about output VAT, input VAT, or net VAT. We are talking about net payable or receivable, whatever is the final answer. But we are talking about net. We are not talking about any gross. Sales output VAT 66,900 divided by 100 multiplied by 20. Standard rated sales expenses amounted to 19,200. That works out to be. Thanks, Aisha and Kamal. By what date at least VAT return for the quarter ended 31st March 25 have to be submitted to HMRC? So the return submission deadline is 1 month and 7 days. 1 month and 7 days is the return submission deadline, right? And this is return submission and payment both. So if 31st March 25 is the relevant quarter end, then the due date would be 7th March 2025. Right? Last. Which VAT scheme would provide a lease with automatic relief for impairment losses? Cash accounting scheme, flat rate scheme, annual accounting scheme, none of the schemes. Before I talk about, maybe I have some time left so I can talk. General principles of these schemes. General principles for cash accounting scheme, flat rate scheme, Annual accounting scheme. General principles. Output VAT and input VAT and output VAT. In the flat rate scheme, there is no concept of output VAT and input VAT. Directly, net VAT payable is calculated based on output VAT. Here, output minus input approach is followed. Here, output minus input approach is followed. Quarterly returns, cash accounting scheme, quarterly returns. Flat rate scheme, quarterly returns. Annual accounting scheme. One return annually. Tax point. Normal tax point principle applies. Normal tax point principle applies. Cash accounting scheme. The tax point is on cash payment or cash received. Since it is on the basis of cash paid, cash received, hence cash accounting scheme is the one where there is no concept, where there is no fatigue of bad debts or impairment losses. It gives automatic reliefs of sorry, I was like fully engaged in writing these scheme summary. Dua, this complete video as in today's class complete video you are referring? So I I just know its recording would be available, whether it will be on YouTube or on portal. I really don't know. Drop me a message on WhatsApp. I'll respond to you once I'll get the feedback from that. So at the moment, I really don't have the feedback from like, so I know it's recorded. I know it will be uploaded. Where recorded, where uploaded, I really don't know. Um, Drop me a note. I'll respond you. Okay, Dua. Um, so to everyone, I'm not sure. I tried my best to make this time fruitful, useful for you guys. I'm not sure how much I'm successful, but it's not end. It's day one. Tomorrow, tomorrow we have another class, and for tomorrow class, I can tell you what's my agenda. So for tomorrow class, the idea is we will be practicing one, and if time allows, two Section C type questions, Section C questions from the ACCA portal directly. So not my questions, not exempted questions, directly from the ACCA portal. Okay. So tomorrow class, same time, please do join the class on timely basis. It's 3 p.m. Pakistan time. I'll get back on the recordings element. It is available, not available type of stuff. Uh, any further question, and please do keep asking the questions, because the more you ask, the more better it would be for you guys. Okay. Um, that's it from my side. If anything further anyone want to ask, I'm happy to answer. Otherwise, good time to say goodbye to you guys. See you tomorrow, inshallah. Uh, Take care in the meanwhile. Allah Hafiz. Thanks, Kawal. For sure, Dua, drop me just a note on WhatsApp. I'll get back on that. Okay. Thank you very much. Allah Hafiz.